Good afternoon. It's 2 o'clock Eastern Time on a Friday, just before Super Bowl weekend. I want to thank everyone for joining us for our regularly series of webinars. We're going to be talking about investing this year with an eye on the complete decade. We've got a couple things to keep in mind here. One is on the right, there's going to be a poll which talks about how the markets are going to do this year. We would ask you to take a moment and give your best guess on that and submit it. At the end of our webinar, we're going to share with you what the consensus was. We're also going to have a question and answer period at the end. So what we'd like you to do is, if a question arises that you'd like us to address, you are permitted on the right to write it down and submit it to us. At the end, we're going to try and get to as many of those as possible. So without further ado, I am so lucky to be joined here by Fritz Schoenhut. Fritz came to Point View after nearly 6 years at Goldman Sachs. He holds a master's in taxation from Baruch University. So he's got a great background of investment experience, financial planning, tax, and he did his undergraduate work at the University of Notre Dame. We're going to tag team this a little bit. So at this point, I'm going to turn the mic over to Fritz. Welcome, Fritz.
Thank you, David, and thank you everyone for joining us here at 2 o'clock. We're excited to present to you our investing in 2020, a new decade with new opportunities. So to start, I just want to set the table, give you a little background on who we are here at Point View, and a little backward looking, kind of where we've gotten to where we are today. So first, Point View, we're a Summit, New Jersey-based SEC registered investment advisor. We've recently become part of PPAC Private, which is the wealth management division of PPAC Gladstone Bank here in New Jersey, which manages and oversees over $7 billion of clients' assets. What we pride ourselves on here at Point View is bringing together the customized investment management and holistic financial planning all under one roof for our clients, which are made up of individuals, families, small institutions. And we look to manage for tax efficiency and transparency, primarily by using individual stocks, individual bonds, rather than solely ETFs, mutual funds, and like that. Our minimum investment or minimum relationship size is $500,000, and that spans across multiple different accounts, whether it's an individual and an IRA and a 529 plan. We aggregate everything all under one relationship. Our annual fee is 1%, and that includes the investment management fee as well as the financial planning side as well. And our clients typically save versus a lot of other advisors in that you're not paying for the ETFs and the mutual fund fees as well. Alternatively, we do offer our financial planning for a $7,000 flat fee, and that's credited dollar for dollar if you do decide to move forward with an investment relationship as well. And lastly, what our clients like is that we custody our assets at Fidelity. So any day or night, you can log into their website, look at your account positions, the activity, and you'll get your monthly statements and all of that directly from Fidelity. So, and here's a picture of our team. Good looking team there. I got David and Claire Toth up front and center, followed by the portfolio managers and client service representatives behind them. And lastly, just a quick slide, some of the national recognition we've gained over the years. So as mentioned, we want to kind of give you a look back and show you, how things have done and where we are today. And so stocks certainly were up big in 2019, up over 31% when you include dividends as well. But some of that's a bounce back from 2018, where you saw the S&P drop, close to 5-6%. And in Q4, a 13+% drop. So definitely a difficult year in 2018. But taking a step back, the decade has certainly been strong. We've seen this long bull market with the S&P up about 13% annually, which is the fourth best decade on record. And of course, though, if you look back beyond that, the previous decade, not so great, where even the international stocks outperformed the U.S. And a lot of this was due to the subprime crisis, which sparked at the end of the previous decade and saw stocks drop 50%. So if you take a look here on this slide here on page 6, you get a sense of the 10-year returns of the markets, but really just the outperformance of the U.S. equity market. So that top line there, that's the United States represented by the S&P. And then beneath that is all countries, including the frontier markets. Then you have your developed, your emerging markets, and the frontier markets as well. And so certainly the U.S. market has had this relative outperformance versus the global equity markets more broadly. And that kind of dives into some of our thoughts and rationale coming into 2020 and the decade ahead of us. And then lastly, this is a chart that I like to see. It is I call it the quilt chart. And so you get a good sense of the dispersion of returns across different sectors of the U.S. market. And so clearly in 2019, as you'll see on the far right of that graph, large cap equity really outperformed the various other sectors and categories of the underlying markets. And this includes fixed income and commodities as well. But if you look back over the past 10 years, different areas of the markets, different pockets have had, their moments of shine, and you've seen, small cap and emerging markets have had several years each of outperformance. And so, the previous year's winners are not always guaranteed to continue on winning. And I think that's a point made clear with this chart. So I'd like to now turn it back over to David to give a sense of what we expect for this coming year.
Hey, thanks so much, Fritz. So, a 1-year forecast in this business is fraught with risk. Anything can happen. We're going to talk about some of the things that could drive it. But, like raising a kid or building a business or a lot of things, it's a multi-year endeavor. But nevertheless, we have to give 1-year forecast that's expected in the business. So what I just want to cover right now on this slide is just a couple of the themes which are going to affect it. One is going to be corporate earnings. When you buy a stock, you're really buying a stream of cash flow. So we're going to look at those corporate earnings. We're going to look at valuations. You're going to get that stream of cash flow, but how much are you going to pay for that? So we want to do a little bit of a dive into that. Interest rates. Of course, people have an opportunity every day to buy a stock, or they could buy a bond. And so the interest rates on bonds are going to affect how people act in terms of Wall Street, and it's also going to affect activities on Main Street. Federal Reserve. They set interest rates, at least for the shorter maturities. So we want to get some insight as to what they may be up to. Trade policy. The more trade, the better, but taxing it reduces it. So what's the outlook there? The economy. We're all going to be more prosperous if we have a robust economy. Let's take a look at that. Fiscal policy. Basically, the biggest economic player on the planet is the U.S. government. What do they have in store for us coming up? Sentiment. Quite frankly, you're going to be more active. You're going to spend more money. You're going to work harder if you feel good about things, and vice versa. So let's take a look at that. Of course, geopolitics. War or other activities, as we're hearing about in the news today, like the coronavirus. So just drilling down a little bit into corporate earnings, let's take a look back. Last year, corporate earnings were a big fat C. There basically was no growth. But in fairness, 2018 benefited from those tax cuts where the corporate rate went from 35% to 21%. So that really juiced earnings in 2018, which made it a very tough comparison for 2019. However, corporations did their best, and I'd have to give them basically an A for beating expectations. And that helped us. So the question is now, what do we see going forward? Well, because of some tailwinds that we're going to talk about, we think corporations can make more money in 2020 than they did last year. How much money? Some people talk about 10%. We tend to be a little bit more conservative, and a lot of pundits get more conservative as the reality of the new year progresses. So we're going to go with, let's say, 8%. But of course, remember, it's not just how much is left in the till. after subtracting expenses from revenues, is also how many shares are those net profits divided into. That's where stock buybacks can come into play. And we've seen over the last decade corporations buying back their stock, and actually that has a positive effect on earnings per share. Valuations. So since we didn't really make any more money in terms of corporations last year, but stocks went up, including dividends, over 31%, what's that tell you? That means valuations increased dramatically. So people were willing to pay a lot more for that same dollar of profits. When you talk about valuations, there's actually a number of ways to look at that. The most widely used one is really the price to earnings multiple, but the price to sales, price to book, price to cash flow, those are all other ways to measure it. Now, in terms of where we are historically, quite frankly, we're at the upper range of what has historically been the norm in terms of valuations. There's probably a bit of a yellow flag. But of course, there's always a situation where we were far more expensive. And that was in the late 1990s and year 2000. We are cheaper than the tech bubble. Thank goodness for that. But of course, valuations should be looked at in the context of interest rates. The lower interest rates, the higher valuations can be justified. Interest rates. Speaking of interest rates, well, you can see by the chart going back, about 70 years, we're kind of at the low end of the historical range for interest rates. You can see there in the early 80s, interest rates hit their peak at close to 15% on the 10-year Treasury. In 2016, we got to a post-World War II low of 1.35. The 10-year yield right now actually is about 1.55. And significantly enough, that's below the dividend yield on the stock market, which is about 1.8%. So the question is, why are yields so low and where are they going to go? Well, inflation is a really important factor in determining interest rates. The more inflation there is, the more lenders are going to demand in terms of interest to offset the erosion of the value of their money when they get it back from a loan. So depending on your outlook for inflation, the lesser the inflation, the lower the interest rates, and vice versa. Of course, we're not here in a vacuum. Interest rates are much lower overseas. It tends to put a lid on our interest rates here because people, let's say, sitting in Germany where there's negative interest rates, they're going to take their money, convert into dollars, buy our treasuries. That's going to keep a lid on our yields. So that's something to look at. Of course, the Federal Reserve has helped engineer lower interest rates and seems to like it that way. They say they're on pause. Having said all that, pundits prognosticate, the gods laugh. Interest rates are very difficult to forecast. Speaking of the Federal Reserve, let's look at what they're up to. So post the subprime crisis, to get the economy back on its feet, it slashed interest rates dramatically, and it bought bonds left and right to lower interest rates, to incent entrepreneurs to invest in the economy, to incent investors to get out of bonds and buy stocks. They did a pretty good job of that. Then, of course, in 17 and 18, they start to hike rates because they were afraid that they were perhaps going to overheat the economy. And then in 2019, they reversed course. They decided they'd gone too far, that we needed a little shot in the arm, and they cut interest rates 3 times. Now they say they're on pause. Nevertheless, we believe they have a dovish tilt. What does that mean? They are more prone to cut rates further than they are to increase interest rates. And we're going to see what they do now in light of the coronavirus. They're watching it very closely. Trade policy. Hey, the fact of the matter is, if whoever specializes in making candles makes candles, and whoever specializes in making shoes just makes shoes, and they trade with one another, both parties are better off. Trade among countries generates a stronger global GDP, period. So anything that's going to impede that trade, whether it's a flat out wall or some sort of a tax on the trade, is going to be a negative. This country has used tariffs against the world's second largest economy, by the way, that would be China, in an attempt to achieve some longer term economic advantages. But in the near term, that has reduced confidence, raised costs, and weakened the global economy. Nevertheless, the last quarter of 2019, markets responded well to a thawing of those tensions, which culminated in a signing of a so-called phase one. So at least we're pointing the trade policy issue in the right direction. Economy. So the domestic economy seems pretty strong. We just got numbers yesterday, which showed the GDP at 2.1% for Q4. Now, admittedly, that's the slowest pace we've seen in 3 years. What drove it in a positive direction was consumer spending, constituting close to 2/3 of our GDP. That was driven by the fact that our unemployment rate is really the lowest we've seen in about 50 years. So not only do people have jobs, they have the confidence that if they left a job, they could get another one. That's going to cause them to spend more money. That's a positive for the economy. But the 1/3 of the economy that's not involved with consumers is manufacturing. Manufacturing has been contracting. A lot of that has to do with confidence in the boardroom as they've seen the trade disputes, as they've seen weak economic conditions overseas. They've been loath to invest more, invest further. So that's a drag on the economy. And remember, a dollar spent building a factory actually has more stimulative power than a dollar spent by you or me going out to the movies or what have you. Now, overseas, economic conditions are much weaker than they are here. Indeed, one of the most powerful countries economically is Germany. Due to Brexit, due to the Sino-American trade war, Germany is now in recession. China, of course, has been the big grower, but they're certainly growing at a slower pace than they have been. One wild card that we're looking at is that although interest rates are close to zero and don't seem to have much effect in Europe, unlike our country, some of those countries are generating surpluses. Will they use some of that money to jumpstart their economies? Speaking of our country, fiscal policy, sentiment, geopolitical, all factors. In terms of fiscal policy, it's really a couple things. One is, will this country spend more money? A logical destination for more spending might be infrastructure, which would facilitate trade and commerce. That would be good. The other side of the coin of fiscal policy is changing the amount that they're taking in. Tax cuts spurs the economy. Although longer term, there can be effects because of a higher deficit and more debt. Deregulation or more regulation, if done properly, perhaps can stimulate economic growth. We're in the middle of a political campaign. People are talking about fracking or banning fracking. That could have an effect on areas in energy prices. Healthcare is also being scrutinized quite carefully. In terms of sentiment, what conditions, of course, will tilt you and me to invest, spend, and save. Right now, consumers seem to be in a pretty good mood. In many cases, it correlates very well to what the NASDAQ is doing. So we're going to watch that quite closely. Geopolitics, we've already seen in just the first month of the year, a lot of friction between the United States and Iran. But what's the outlook for that? Have both sides kind of realized that they don't want to engage in war and they're going to stay in their corners? And of course, where does North Korea come into play? Venezuela. Got to watch that closely. And of course, we've got the coronavirus. It's a human tragedy. There's no question about it. But we have, of course, looked at epidemics going back, frankly, close to 40 years, and all save for one involving HIV and AIDS in the early 80s. The market was significantly higher a year from now. Let the vaccine makers get on top of it, and things have historically worked out. But of course, it bears very close watching. Energy prices. We can't do anything, heat our homes, take a car trip right now without buying fuel. So we're going to look at energy prices closely, the trade negotiations and investment plans. And of course, the one thing people never really want to talk about is the elections, but that's coming up too. There's some radical plans, depending on who you talk to. The other side is going to destroy the economy. If I could just say one thing about elections, it is that the beauty of our system is you got to get three bodies to agree to make any major change. That would be the White House, the Senate, and the Congress, and they rarely agree about anything, which means there's gridlock, which means basically the rules stay constant. Bottom line, our forecast for this year interest rates pretty much stay where they are. We're already lagging a little bit of that forecast because they've already come down a bit here in January. Stock prices move up with earnings 5 to 10%. We're on track, but with the sell-off today, in the month of January, I think it's going to start out flat, but we still think they're going to move up with the earnings. By 2021, of course, investors are going to be focusing on the outlook for 2021 in terms of earnings and policy. Federal Reserve, we hope they stay on hold. Most people think they will, although there is a possibility that they cut rates further. Trade disputes, we basically think the White House was going to want to back burner that. They don't want that to tie up the headlines as we get into November, the all-important election. Well, China is facing a slowing growth that can lead to antsy people in the city, so they're going to want to be amicable in that regard. And finally, we think that the energy, healthcare, and banking sectors will show the most volatility because those are some of the sectors where some of the political proposals might have the most effect. So with that, I'm going to now turn the slides back to Fritz.
Thank you, David. And so now we'll move on into how does all of that inform our investment strategy heading into the new year. We'll tackle some of the issues or the points here on slide 17, starting with rebalancing. And so the first and foremost step when it comes to creating a portfolio as an investor is to establish your asset allocation target. You have to consider your time horizon. You'll have to consider your risk tolerance, and you express all of this as a percentage. Typically, some percent equity, some percent fixed income at the most basic level. And so on the left side of this slide, you'll see two little pictures. The first being the representation of rebalancing on an annual basis over 30 years. And as you can see, at a 50-50 allocation to bonds and stocks, the risk level stays pretty much constant or pretty stable over the course of those 30 years. Now, on the other end of the extreme, if you have never rebalanced over 30 years, you see the stocks historically outperform bonds, but that increases the risk level in the portfolio as the stocks become a larger and larger part of your overall allocation. So after a strong year in 2019, as we had, it's important to take a look at your portfolio and consider, rebalancing back to your strategic targets and doing that on a regular basis, whether that's monthly, as we do here at Point View, quarterly, or even annually, to do that and to always also consider the tax consequences and look for opportunities and buying low and trimming when things get a little bit frothy, a little high. So next, other things we're looking at. So cyclical and value stocks. We're seeing some opportunities in these two areas. And you see on the cyclical side, they're trading, and on the value side, they're trading at a steep valuation discount relative to the overall market. The price to earnings, as we've noted here, 11 versus the market's current 19. Pretty good discount there and consideration for adding to your portfolio. This is nearly 20% below their 5-year average. And in the chart here on the left, you'll see the ETF for the financial sector. Financials haven't kept up. Interest rates have definitely been a headwind for the overall sector, but we favor going into 2020 and this new decade. These stocks, some financials that we like are Capital One, Synchrony Financial, and Wells Fargo. International stocks. So as you recall from earlier in the presentation, where I showed the chart over the past decade of the U.S. relative to the other international and global markets, international stocks have certainly lagged their U.S. counterparts over the course of not just last year, but going back that past decade. And to the point where valuations are increasingly attractive on the international side. And another note is the dividend yield. So dividend yields offer a big premium over their the fixed income yield on the international side versus here in the U.S., where they're much closer in their rate. And so we see opportunities on the international side, and some of those include British Petroleum (BP), Vodafone, and Anheuser-Busch InBev.
Thanks, Fritz. I'm going to talk a little bit about technology. We fundamentally like technology. Why is technology so appealing? Because it's providing us the tools for new forms of entertainment, for new ways to be productive, new ways to communicate. And the tailwinds behind these changes are so strong that they may not be particularly affected by the ebbs and flows of economic activity. In other words, they have secular as opposed to cyclical tailwinds, secular growers. The other reason that we like technology generally is that it provides you with global exposure. The same phone that you might buy here, you could also buy in China or you could buy in Europe. The same sorts of technology to communicate for social media and so forth can be used worldwide. Having said that, of course, everyone wants their own country's technology to be used. And so in the course of, they could be held hostage in a trade war. And of course, everyone wants to be able to take someone else's technology and use it for their own purpose, intellectual property theft. So those are something to look at. So in terms of a couple names that we like here, two would be chip plays. INTC is Intel, AMAT is Applied Materials. Why do we like Intel? Intel is your world's largest semiconductor manufacturer, and semiconductors are having increasing application everything, whether you're talking about artificial intelligence, autonomous driving, in all sorts of phones and so forth. It's really has a ubiquitous presence. Intel, through strategic acquisitions, Mobileye, and other acquisitions, now has their fingers in all those different pieces. So it's a easy play to get broad exposure. Plus, the valuation remains reasonable. Indeed, you get a dividend there. It's close to 2.5%, which is above the S&P 500. So we like Intel for the long haul here. Applied Materials makes the equipment that allows companies like Intel to make chips. So again, they're really a source for companies, whether they're in Taiwan, whether they're in the United States or Europe, who are making chips. They source their equipment from Applied Materials. The stock was one of the big winners last year. It was almost doubled from Christmas Eve of 2018. We still think there's more room to grow and gives you good long-term exposure. Fixed income. So fixed income is kind of controversial here because, a lot of people say with interest rates so low, why do we bother with it? And my analogy on that is it's like opening up your mail and you get your bill for your premium for your auto insurance policy and it's doubled. And you say, this is crazy. I mean, why should I pay this much? Well, you know that you never know what's going to happen. And you got to have the auto insurance. And guess what? In the markets, indeed, look at a day like today, you never know quite what's going to happen. So I think you hold your nose and you include fixed income in your portfolio. But how do you do it as strategically as possible? One is hold it in tax sheltered accounts. Now, why would you do that? Because fixed income is taxed at your highest rates. And if it's held in a tax sheltered account, you sidestep any current taxation on it. Now, you can buy tax exempt bonds, but you get a lot less yield. In fact, some of the lowest yields that have ever been seen. So if you can avoid having to hold fixed income and taxable accounts, you're ahead of the game. But of course, if you do have to hold it in a taxable account, maybe you don't have an IRA or 401k, then definitely look at tax exempt bonds so that you maximize the after-tax return on your money. Don't go out too far, because if interest rates get volatile, the longer the maturity, the more sensitive they are. We're at very, very low interest rates. That's prior slide we showed you depicts that very clearly. If interest rates move up, old legacy bonds with low interest rates are going to move down. No one's going to like that. So limit the maturities to 10-year or less. And we like to almost kind of diversify it. So you divide your fixed income portion of your portfolio by 10, by 1/10, 10 years out, another 10th, 9 years out, and so forth, right on down to 1 year out. That way you always have some bonds maturing, which then can be reinvested and take advantage of the new interest rate regime or used for other purposes. Smaller companies look good too. They have gotten off to a rotten start. Indeed, the Russell 2000, which is what this chart shows, is now smaller than the two biggest companies on the planet. That would be Apple and Microsoft. So what's my takeaway from that? Either Apple and Microsoft are too big and too expensive, or the Russell 2000 is too cheap. It's probably a little bit of both, which suggests that the smaller companies may be a safe haven, a little less exposure, definitely to places like China and things along those lines. And then, of course, we also like healthcare. It's the other growth sector. It's been out of favor due to political concerns with various proposals, actually from both sides of the aisle, to cap drug costs, to change how healthcare is paid for, has kept a lid on valuations. Many of them offer great dividends. Two we particularly like. One is Pfizer. You have your largest R&D program in the world. You have your largest sales force. You've got a dividend which is approaching 4%. And then finally, CVS, not just drugstores, but also healthcare pharmacy benefits, and also is now integrated with Aetna Insurance. So you got a couple different healthcare things in one company there. So this concludes the formal presentation that we have for you in this webinar, but now we want to take a few minutes and address some of your questions. And well, let's go with the easy ones first, right? Someone asked, can we get access to this presentation when it's over? Absolutely. And we'll make sure that everyone signed up gets the link or otherwise gets access to it. So here's a good question. With increased and increasing level of U.S. debt, are we getting to the point where the Fed cannot increase interest rates without damaging the U.S. economy by having the interest cost causing reduction of other U.S. government spending? Absolutely. You know, the debt bomb, the deficits, is the big 800-pound gorilla in the room. As that gets bigger and bigger, there's more and more borrowing. That borrowing could get more expensive if interest rates go up. That borrowing could crowd out borrowing in the private sector. And so the litmus test that the Fed has been using is, are we at the point where, you know, today is a classic example. Interest rates are now moving down today. And you know, the question is why? Because people are more afraid out there of a slowing U.S. economy and lower inflation, so they just don't want to increase interest rates. But of course, at some point that will reverse, and that's going to cost our government more money, and that's not going to be good. So here's the positive spin is, interest rates will probably go up as the economy gets stronger. If the economy gets stronger, more tax money will be collected. That's your positive spin. But at the end of the day, we all know that excessive debt is not a positive. Fritz, I'm going to turn it over to you if you want to take one.
Sure. So I see one here. With valuation so high, should I be selling equities and buying fixed income? So I know David pointed out previously in one of the slides, but I think our short answer here would be no. High valuations alone are not a good indication of when to exit the market. I think it's best to put everything into context of the overall environment. We currently have low interest rates, low inflation, a pretty accommodative Fed still. And so from an equity perspective, the high valuations or seemingly higher valuations than, you know, perhaps the historical market average would not be a good indication of getting out of the market here. And just one quick further point, you know, if we look back over the past 10 years, the markets entered their 9th and 10th decile of valuation. So that would be, you know, the markets were valued less 80 to 90% of the time, over the past 7-8 years. And look what the market's been able to do in that period of time. And so our recommendation would be that given the higher valuations, they're not stretched to the point where we would be recommending selling equities and going into fixed income.
Okay, so I see a question that is on everyone's mind right now. The coronavirus is scary. Should we be moving to the sidelines? I think the answer is perhaps, but it all depends on your time horizon. I don't think anyone is in a position to tell you the exact near-term course of any type of epidemic. No one really knows. But we have studied, as we mentioned before, how these epidemics, SARS, MERS, have played out in the past. And historically, the market is higher a year from now. So if you've got a multi-year horizon, probably this is the time to do some bargain hunting. Now, admittedly, these statistics about the number of people who have died and so forth are scary. I think we're up to 230. But let's put it in context. Each year, 650,000 people are killed worldwide by the flu. So health problems are nothing new. What is different now, I would say, is back in 2003 when we had SARS, China was not as big a player on the economic stage as it is today. Nevertheless, just yesterday, the World Health Organization labeled the coronavirus as a global health emergency. But if you look in the past, by the time the WHO puts a formal label on it, much of that news is now discounted into stock prices. So when people say moving to the sidelines, it's like, well, hold it. So you're going to sell stock to someone else who hasn't read the newspaper, hasn't heard the news on the coronavirus? Of course not. So you're going to get less. It's going to discount the apparent risk. So in some ways, you shouldn't have been in the market unless you had a long-term view. If you have a long-term view, our advice would be either to sit tight, or if you're a little more aggressive, look for blue chip companies that can rebound and will be here far after we have stopped thinking about the coronavirus. Fritz, you want to take one?
Sure. Let's see. I see one here. Should I make any changes to my target allocation given the risk of the rising risk of a recession? So the answer again would be to perhaps revisit the allocation if anything material has changed in your overall place in life, or to think more long term. I think the most important thing is to make sure that you have the correct allocation at the very onset, and knowing your time horizon, your risk tolerance should be able to weather you through the ups and downs of a full market cycle, with a recession included. Markets are going to go down, and I think if you have the right time horizon, the right focus on the long term, then perhaps seeing that as opportunities to rebalance and readjust, and maybe move some from fixed income to equities, to keep your target or your portfolio still in line with the target, but to make a shift in your allocation based on what may or may not happen in the next year, 2 or 3 years, would not be the advice that we have.
Fritz, I think we've got time for one more question, if I could be so bold as to field it. Sure. Very topical. And the question is, the president is being impeached. Why is this market anywhere close to being at all-time highs? That's a great question. I think there is a couple answers to that. I think that investors are saying, well, what's the end game here? And quite frankly, people have looked at all the news, and they looked at the Republican majority in the Senate and have said that the news that we have heard so far doesn't seem like it's going to sway the Republicans in the Senate, and therefore there's going to be no change in the administration. I would submit that you actually want to go a step beyond that and keep looking at public opinion polls. And right now it seems like only half the people think the president should actually be removed, and the other half either disagrees or isn't sure. And so it's just not enough to create a change in the expected voting pattern in the Senate. Of course, today they're going to be addressing the question as to whether there should be witnesses. The latest news, Lamar Alexander, who is one of the 4 Republicans that might have been on the fence, has said he doesn't want to see witnesses. So it looks like there's not even any witnesses. Therefore, the impeachment might be over by the end of today. I think going further out, most of Wall Street is saying they're not even seeing any change possible in the, they think Mr. Trump is going to have another term. And so whatever has been going on in terms of lower corporate taxes and a more light regulation environment is likely to continue, and that's enough for the market. Of course, remember, anyone in the market should have a very long-term perspective. I love what Warren Buffett says about that. He talks about during his investing career, he's had 8 Democratic presidents, he's had 8 Republican presidents, and people go to work, they keep spending money, they keep being imaginative and becoming more productive through thick or thin, through all those administrations. And so he doesn't think who's in charge is all that important. And I would submit, again, gridlock is one of the key successes of the American system. Things don't change too quickly. And if they do change, you still have the Supreme Court to check it out. So that's, I think, is our answer there. So at this point, I want to thank you all for taking time to listen to our webinar. We'll be reaching out to each of you to make sure that you have access to the full amount of slides. We would welcome any questions that there was a number of questions that didn't get answered here to submit them to us. We would be have pleasure in answering them. And we plan to have a webinar each month and hope to see you at another one in the not too distant future. Thank you.
Thank you.